Hey guys, it's Rob Jones with Deerwood Capital. I'm going to talk to you today about investing, and answer two questions. What the S&P 500 is and why it will go up over time. So the S&P 500 is an index fund. I'll tell you what an index fund is. And then the second part, why it will go up over time. That's an opinion, but it's shared by Warren Buffett and plenty other of his successful investor buddies, like Jack Bogle, who actually invented Vanguard. So there are a lot of people smarter than I who agree with me, thinking that the S&P 500 will continue to rise over the long term. Why is that important? Okay, well, Warren Buffett has come out and said, hey, I'm going to put my wife in index funds when I pass away. So my investing playbook is going to be shared with all you. I'm going to put her in 90% index funds and 10% bonds. This was shared in his will, and he told his shareholders in his letter back in 2014. So why is that important? Well, this guy's made billions of dollars investing. I think it's a good bet to listen to what he does and also try and understand why he thinks that's a good bet. And that's what I'm going to do here for you today and break it down. What is a stock index? A stock index is a group of stocks. Okay, the S&P 500 is a stock index. You can also have a stock index that tracks small companies, that groups and tracks Chinese companies, that groups and tracks large companies, that groups and tracks dividend-paying companies, tech companies, etc. Okay, so there is a huge amount of indexes out there. As a matter of fact, there are more indexes or groupings of stocks than there are stocks, which is really weird. And the way I explain it, of course, goes back to food. All right? If you had a burger, french fries, and a drink as a restaurant, and you had 7 menus, I think this would be a good comparison to what the stock market is offering today. So you would have a burger on a menu. On a second menu, you would have fries. Third menu, just a drink. Fourth menu, burger, fries. Fifth menu, burger, drink. Sixth menu, fry, drink. And of course, 7 would be all 3. Normally, we just get all 3. And that's the cheapest way. That's all of them on there. The most efficient way. The restaurant doesn't have to pay all this money to create all these menus. And as a person eating there, you don't have to look at freaking 7 menus to choose what you want. You can just order a la carte, right? So why does this exist in the stock market, and why does this exist in your portfolios and all these plans, and why are there these choices, so many choices? So one theory, and I kind of have seen this over and over again since working in the industry for about 8 to 10 years, is that the people who make the menus in the stock market are different financial firms. They're different institutions, okay? And they get paid based on how many people use their menus, right? So if you were to think about them as helpers to the restaurant, yet they could charge the restaurant and the people eating at the restaurant, us, different fees based on what menu they use. And then also they would, spice it up and jazz it up and make it these fancy names and try to point to how good hamburgers are compared to French fries and all this crap. It's very confusing, a lot of choice, and it just doesn't make sense to me, okay? Like, I just don't think it's all that efficient. Anyways, you can talk to me more about that if you have questions. I'd love to hear from you. Comment down below or, give me a call. So let's move on. As you see, I have a blog post here. Basically, I post this the night before. I put the video up the next day, and to save me time, because I got to get back to work, I'm going to go over this, reading these from here. If you want to learn more, there's more detail in this blog. Go to deerwoodinvestments.com, click on the knowledge link, and boom, you have a lot of my writing. So we got what an index fund is. Basically, it's a index that tracks the performance of stocks, and the S&P 500 is actually an index that tracks the performance of stocks in the 500 largest publicly traded American companies. Other popular indices in the US are the NASDAQ and the Dow Jones. I'm sure you've heard of those before. Now, indexes like the S&P 500, there are funds that track that, and this gives us a very efficient way to grow and participate in the fortune of American businesses. You can invest in several index funds that all aim to track the S&P 500. So at our firm, we use tickers SPY, which is provided by State Street. They're called the Spiders, and it tracks the S&P 500. We also have clients who use VOO, which is Vanguard, and it does the same thing, tracks the S&P 500. I just tell you that because of transparency. We also use different index funds that I'm not going to talk about here and the reasons why. And we also use individual stocks. And my business is completely different. We like to use this as fundamental basis of our analysis and strategies that I use with clients. And that's a good point as well for me to tell you that this is all education. Okay, I'm not telling you to go buy anything. This isn't an offer to go buy. It's not an offer to me sell you anything. I'm happy to help you because one, it helps me reach more people doing these videos and scale. But two, man, I really think if you can believe just a little bit of investment knowledge and agree with it, the logic behind it, I think you'd be better off in the long term because you won't be selling when everybody else is selling, like we talked in the last video. Okay, you want to buy when the streets are bloody, even if the blood is your own. Okay, all right. So now that you understand what the S&P 500 is, let's jump into the reasons why it may continue to go up over time. All right. So just looking at this graph here, you can see that since probably 1928 all the way to 2010, the S&P 500 has risen over the long term. In the short term, we don't know what's going to happen. People may tell you what they think is going to happen, but again, that's just opinion. The market is way smarter than anybody out there. All right, there are some people who can outsmart the market and beat the market, but they're very few and far in between. Now, why does the S&P 500 go up? All right, I think there are three very important factors. Okay, one is diversification, and this first chart here is diversification through what I like to call survivalhood. If you just own one share in the S&P 500 index fund, and you had that share in 2012, you would have a combination of companies and these ones here. But as you can see, Compaq, Sears, Kodak, Circuit City, they haven't been too successful as of late. And as a result, since 2012, they've actually been booted out of the fund, of the S&P 500. So if you were a holder and you held it from 2001 and you still have it to present, then you wouldn't be holding Sears, Compaq, Bear Stearns. Like all those losers would have been kicked out of the fund, and the fund would have sucked up Netflix, Amazon, E-Trade, eBay, Google, Whole Foods. Essentially, it's making room for the disruptors. It's making room for evolution of business. And these companies do so successful, they get bigger and bigger. So then they have to move up into the 500 largest companies, the S&P 500, and then the losers get out. And the best thing is you don't have to do anything. You just hold on to your index fund, and that company will do the work for you. The other type of diversification I like to talk about is geographical. All right, if you look at this statement here, the S&P 500 company sales, it shows you that roughly 50% come from the US. All right, 52.2%. That means about half come from the rest of the world. So if the US is stalling and not growing, or God forbid goes into a recession, then there's opportunity for those companies, these huge multinational companies that are American, to still do well and enjoy in the success of international economies, Asian economies, Europe, Africa, Canada, etc. So when the economies of China rises, or Europe, Germany, France, when they rise, these huge companies are rewarded, right? So Chinese people have gotten a lot richer. We've gotten a lot of people out of poverty in China. And what do they demand? iPhones, Microsoft, services from, Amazon. Maybe not China, because it's not allowed in China yet. Maybe it is, but like India and Germany and France and Europe and Canada and Mexico, like these services that we provide as well, even banking institutions provide services overseas. Those companies will continue to gain when other economies are doing well. So you're diversified by survival, you're diversified by geography. So there are two types of risks that we look at diversifying away from. One is called market risk. This you can't really diversify away from, and it's always going to exist. And you can see it in a bear market when just all stocks are selling off because people are scared. You can see it in pockets of the stock market. Let's say, for example, when it was linked that cigarettes can cause cancer. You would imagine when that came out, every freaking tobacco company traded on the exchange would have fallen. So that's another market risk isolated to tobacco companies. So that's risk that you just can't diversify away from. But if you think about the other risk, which we call firm-specific risk, you can diversify away from that. So that's more like, recently Chipotle had a food scare, and of course when that came out, the stock tanked. But if you own McDonald's and Wendy's and Pizza Hut and Papa John's, those all weren't affected. So that firm-specific risk is something we can diversify away by owning a bucket of restaurants rather than just putting all your eggs in one basket, and that being Chipotle. So I hope that makes sense. Let me read up here real quick. Yeah, we went over survival. We went over that and that. We did that. Okay, so yeah, one more thing. Looping in our first session of not losing money. Costs are another way of losing money. So costs. We want to eliminate costs at all chance. You need to pay attention to costs because they might not seem like much year to year, but the rationale is simple. Like the more costs you pay, the less money you get to invest. And currently with the trend that we have of more products and index funds than stocks, you would see a lot of costs. And the worst part is that they lack visibility. And within these funds, it might not say everything because it's just inherent in the fund business model. So for example, if I ran a fund that tried to track small cap companies, so very small companies you probably haven't heard of, and let's say I like to turn over all the stocks 3 times a year. That means I'm buying and selling every one of these stocks 3 times a year. So buy, sell once, buy, sell twice, buy, sell 3 times a year. That's 6 transaction costs. So that's something like you would see in a portfolio turnover ratio. And it's as low as 3%, which is typical for like the S&P 500, but it can be as high as 100, 200, 300%. And those are the types of transaction costs and costs that you don't see on a prospectus. Like you don't see it in Yahoo Finance, and it's getting harder and harder to calculate. And I'm going to show you what I'm talking about because I think graphs are a much better way to present these complicated information. So here is a nice graph that I found from the visualcapitalist.com. Basically, here's your expense ratio, okay? And it would say 0.90%. This covers marketing, distribution costs, as well as management fees. This is the only cost that most investors are aware of. Now, beneath the water, all right, this is a glacier. Beneath the water, the glacier is much bigger. You have these transaction costs, exactly what I was talking about. They can cost you on average 1.44% a year. Cash drag, that's just holding cash and as a result not earning money on that cash, but them holding cash. Taxes, mutual fund gains are taxed, and when you buy into a fund, sometimes you even tax for other investors' previous gains. Advisory fees, soft dollar costs. Okay, so it's been said that according to the Forbes article, the total of these costs can average as much as 4.7% annually for a typical actively managed fund, though of course costs vary from fund to fund. All right, here's a link. Again, I'm just looking at this at deerwoodinvestments.com. There's a lot more information here for you to look at. Please go on, read it. And then last but not least, we're going to talk about compound interest. All right, this is going to be a nice segue for our next segment. We break down compound interest. But yeah, these costs might not seem like a lot. Over time though, like this classic example, they will add up and harm you in the long run. There's a reason why Warren Buffett has said Wall Street and hedge funds and advisors have cost clients roughly $100 billion over the past decade. All right, if he believes that, he's probably done enough research and thought about it enough to come out and say that in public. This is a perfect example, all right? A penny day one, compounded for 30 days. If you doubled it every day for 30 days, you end up with about $5.4 million. The power of that message can be applied to costs. And if you're paying a lot of costs because you see in your portfolio, or you just see in, you're just starting out and you see by these funds, looking at these expense ratios and whatnot, if you pay all these costs, they just add up and add up and add up. And year over year over year, they're compounding because you don't have that money. You paid it out. And this can significantly draw down your returns over the long term. And you'll never see this because it's like this glacier. They're kind of hidden costs. Where you would see this is if you compared it to the S&P 500 and said, all right, what's my fund doing, my money doing, compared to the S&P 500? Why not earn your fair share of profits by just investing in the S&P 500? So that's kind of the logic. Everybody's different. You got different risks. You got different time horizons about your investments and what you want to do. But I hope you can understand why that argument is sound, why it's so strong, but it might not be the best strategy for everybody. Again, we use a different strategy. That's the basis of it. We use some of these funds, as I mentioned, and we'll talk about more about compound interest, why it's so important, why it will continue to make the S&P 500 rise in value over the long term, and then really what it is and how it's different from maybe a fixed bond simple interest. And then we'll continue to go from there. So I'm Rob Jones again with Deerwood Capital. Thank you guys. I really appreciate you listening. Mark down in the comments about what you liked best in the video or what you want to learn more, and just give me some feedback as I try to get better at this every week. Thanks, guys. Bye. Bye.